So guys, we'll start with reading number 7 of the CFA curriculum that will tell you about the behavioral finance perspective towards understanding market behavior and towards understanding finance. So we'll start by comparing traditional finance with behavioral finance. Understand the theory of risk aversion as is given by traditional finance. Understand the challenges to the traditional finance theories. The utility theory and decision theory, again a part of traditional finance. Then we'll start moving towards understanding the concepts of behavioral finance, starting with bounded rationality, the prospect theory for evaluating investments, that has the phases of editing and evaluation, and finally wind up with understanding capital markets and the process of portfolio construction from both a traditional finance perspective as well as a behavioral finance perspective. Now, traditional finance essentially is prescriptive in its approach. So it focuses on how individuals should behave. The assumption is that people are rational, risk averse, and utility maximizers. So they want to maximize the benefit for a given amount of risk, and very importantly, people have complete information and complete processing power available with them to make these optimal utility maximizing decisions. These individuals who have full information and are risk averse act as rational economic men, which leads to efficient markets where prices reflect all available relevant information. So everybody analyzes, assesses the information instantly, does all the analysis that needs to be done. Hence, markets tend to be efficiently priced because people are rational and economic. So again, it tells us what to do. It is a prescriptive analysis that tries to look for tools and methods to find rational solutions to decision-making problems. For example, which stock to buy, how much risk to carry in your portfolio, how much private equity to include, so on and so forth. Behavioral finance, on the other hand, is descriptive in its approach. So behavioral finance focuses on how individuals actually behave, not how they should behave. So it tries to understand post facto that why do people behave in particular manner and why do people make decisions the way they do, sometimes which are not in accordance with the theory of traditional finance. So the theory of behavioral finance will also draw on the concepts of traditional finance and will further include the concepts from psychology and neuroeconomics. Now the curriculum has a whole reading on neuroeconomics. You can skip the reading. Just know that neuroeconomics draws on the studies of brain chemistry to understand how decision making utilizes both rational and emotional areas of the brain. So they actually study some chemicals that the brains release, which is why people in good moods act differently. When people are in a bad mood, they act differently. Knowing this much about neuroeconomics is enough from the perspective of the exam. Now, behavioral finance further recognizes that the same information can be evaluated differently on the way it is presented and on the way my state of mind is when that information is presented. So this can lead to emotional as well as cognitive biases that we'll study in the next review. Behavioral finance argues that investors or individuals may or may not act in a risk-averse manner. So decisions may be made in a risk-seeking manner at times, as we'll see, or decisions may be suboptimal many a times from a traditional finance perspective. Micro-behavioral finance is concerned or wants to explain why individuals deviate from the traditional finance theory. Macro-behavioral finance tries to explain how and why whole markets deviate from efficiency or traditional finance theory. So traditional finance exhibits the utility theory or the utility maximizing theory that asserts that individuals have a limited budget and will select the mix of goods and services that maximize the satisfaction given their budget or within the budget constraint. This, by definition, includes 4 axioms. So an axiom is a statement accepted as true without any debate. Something like 2 plus 2 is equal to 4 is an axiom. So the four axioms of traditional finance are: first, completeness. So if there's no completeness, traditional finance theory cannot be applied. Completeness means that individuals know all available choices and they know their own preferences and they use them to choose between any two mutually exclusive alternatives. So if you give an investor an option A or an option B, he is definitely able to choose between the two options. This may or may not always be the case from a behavioral finance perspective. So traditional finance assumes that investors can always make this choice and decide which is better as compared to the other. It assumes transitivity. That means individuals consistently apply their completeness rankings. So if they prefer B over A and they prefer C over B, then they will automatically and definitely prefer A over C. It includes independence. That is, rankings are additive and proportional. So if A and B are mutually exclusive choices where A is preferred over B and C is an additional choice that gives us some return, then adding some part of C to both A as well as B will not change my preference. So A plus X into C will still be preferred over B plus X into C. These axioms are important because questions often have included statements and then you have to tell which axiom is getting violated or which axiom does it relate to. So please remember: completeness, transitivity, independence, and continuity. Continuity means that utility indifference curves are continuous. So we saw indifference curves at level 1, at level 2. So these curves are continuous, implying there is infinite number of weightings possible between good A and good B, or between investment option A and investment option B. I can have 0.5 of A, 0.6 of B, or infinite combinations are possible, such that if A is preferred to B and B is preferred to C, then there will be some combination of A and C that will equal B. So this continuity in the indifference curve will come if I can have any weighting of A and B. So let's revise the four axioms. Completeness, investors know everything they need to know. Transitivity, they consistently apply the choices. Independence, adding a similar option to both A and B will not change the rankings. And continuity, that means utility curves are continuous or there are infinite possible weightings of the different assets possible. So these are the four axioms of traditional finance. We will soon challenge them when we study behavioral finance. However important, we must remember. Now, given that the investor has all the information, what traditional finance theory says is that investors have some unconditional probability estimate. That probability that this stock will double is an unconditional probability. We'll call it event A, for example. And the investor has done his analysis and he has some estimate of what is the probability that the stock will double. However, new information keeps hitting the market at random times. Remember the efficient market theory. So as new information hits the market, do you think this investor may need to update his probability of this stock doubling? So let's say there's a fire in the factory, or GDP growth has surprised positively, or inflation is too high, or the central bank cut interest rates. Any such event B that comes in new may require the investor to update his unconditional probability of A. That updated probability, please recall from level 1, can be calculated with the help of the Bayes theorem. Just to refresh the concept of the Bayes theorem, do we all remember the formula for the conditional probability? Conditional probability told us that probability of A given B is nothing but probability of A intersection B divided by the probability of B. That is, if B has already given to have happened, then what is the probability of A? If B is already given, then sample space now becomes B, because possible outcomes are only B. And how many times will A also happen when B has happened will determine the probability of A given B. That is the probability of A intersection B upon the probability of B. Now, probability of B intersection A similarly can be written as probability of B intersection A upon the probability of A. And probability of A intersection B or B intersection A means the same thing, so it will be probability of A intersection B upon probability of A. Or from the second equation, I can deduce that probability of A intersection B is equal to probability of B given A into the probability of A. The second equation can be substituted into the first equation for the term probability of A intersection B, and this will give me the Bayes theorem that probability of A given B is nothing but the probability of B given A upon the probability of B multiplied by the probability of A. Recall the updated probability for an event. What is the update? Event B. The updated probability of an event can be given as the prior probability of the event, the prior unconditional probability of the event, multiplied by the probability of the new information given the event upon the probability of the new information or the unconditional probability of the new information. So traditional finance says that investors have some analytical probability and then they keep updating their probability as new news and new information hits the market. All investors do this at the same time and stocks react instantly, so the market at all points in time is efficient. So please use the Bayes theorem and solve the example. So you have two identical bags, B1 and B2. B1 has 3 red pens and 2 green pens. B2 has 4 red pens and 1 green pen. You randomly choose one of the bags to pick out a ball. A red pen is pulled out first. Question asks, what is the probability that you picked B1 given that a red ball was pulled out first? So let's say B1 is the probability of picking bag 1. Let's say the event B2 represents the probability of picking bag 2. Without any other information or without any update, if somebody just asked you that there are 2 bags, what is the probability that you have picked bag 1? What would your answer be? 50% or 0.5? Both bags have a red pen, we'll depict that by the event R. So R means picking a red pen and G means picking a green pen. So what is further provided is that probability of a red pen given bag 1 is 3 out of 5 and probability of a green pen given bag 1 2 out of 5 because there are 2 green pens out of a total of 5 pens. Similarly, the probability of picking a red pen given bag 2 is 4 upon 5 and probability of picking a green pen given that you are in bag 2 is 1 upon 5. So that's the information that is already given in the question. The question asks that if there is an update, the update is that you picked a pen randomly and the pen turned out to be a red pen. So given that you've picked out a red pen, what is the probability that you were in bag 1? So first thing is depict the question in terms of your events. So what the question is asking is that given that you've picked up a red pen, what is the probability that you are in bag 1? So what is the probability of bag 1 given R? Now probability of bag 1 given R from the Bayes theorem can be written as probability of R given bag 1 into the probability of bag 1 upon the probability of R. Please note these two are unconditional probabilities and this is the conditional probability of picking R given bag 1. What is the probability of picking a red pen given that you are in bag 1? 3 by 5. And what is the unconditional probability of picking bag 1? If there was no condition, the 50% chance that you'll pick up either bag into 0.5. The slightly tough part of the question is to estimate the unconditional probability of a red pen. So probability of R means what is the probability of picking a red pen given these two bags and given the pens in each of them. Now a red pen could either have been from the bag 1 or it could have been from bag 2. That is how a red pen can come. The probability of picking bag 1 is how much? 0.5. And the probability of finding a red pen in bag 1 is 3 by 5. So 50% chance that I'll find a red pen 3 out of 5 times. And remaining half of the times, I can find a red pen in bag 2. So 50% of the times, the probability of finding a red pen is 4 by 5. So what is the unconditional probability without any conditions? What is the chance of getting a red pen? Either it can come from the bag 1 or it can come from bag 2. Probability of bag 1 is 50%, probability of bag 2 is 50%. So the unconditional probability of a red pen would be given as 7 by 10 or 0.7. Hence, the probability that we are in the bag 1, given that we have just drawn a red pen, will be given as 3 by 5 into 0.5 divided by 7 by 10. That will come out to be approximately 0.43. So, the updated probability is slightly lesser than 50%. Is that logical? Earlier, the probability was 50-50. If you've just randomly picked a bag, it could have very well been the bag 1 or bag 2. But now that you've found out a red pen, the probability of being in bag 1 has slightly come down because most of the red pens are in bag 2, or there are more red pens in bag 2. So it's slightly more likely that you are in bag 2 than in bag 1. What decision making in traditional finance says is that investors do this calculation instantly at all points in time, and the stock price reflects these updated probabilities. Traditional finance also generally assumes that individuals are risk averse and prefer less risk. Behavioral finance says that individuals may be risk averse, they may be risk neutral, they may even be risk seeking, or at times it can be any combination of the three. How do we assess the situation, whether a person is risk averse or risk seeking? So let's say I give an investor two options. Option A is 50% probability of receiving $100 and 50% probability of receiving $0. So what is the expected payoff here? 0.5 into 100 plus 0.5 into 0, that is $50. And I give him an option B, that is a 100% probability of receiving $50. An individual that picks either option A or option B is called a risk neutral personality. That means he realizes in both cases my expected payoff is 50. So he probably does a toss of a coin and picks option A or option B because he is indifferent between the two options. A risk averse personality will actively seek option B. He is happy with $50. He doesn't want to risk getting nothing. A risk seeking personality will actively go out and seek option A because he is lured by this probability or this chance of making $100. Traditional finance assumes a risk averse investor. Behavioral finance says that investors can be of any three types. In fact, at different points in their lives, they can be different types. With different levels of wealth, their type can change. So a risk averse person may suddenly become risk seeking. That's why we've seen people buy lottery tickets also, and they buy insurance also. So at the same time, they are risk seeking also and risk averse also, and that's very much possible. These diagrams depict the utility function of an investor. That is, what is the satisfaction he derives from a given amount of wealth? For a risk neutral investor, as his wealth increases, the satisfaction he derives from the wealth also increases in a linear fashion. More wealth, more happiness. More wealth, a proportionately higher happiness is what he feels. A risk-averse investor, remember, has a concave utility function. It will be a convex indifference curve, but a concave utility function. A concave utility function implies that he also achieves greater happiness from having more wealth, but at a decreasing rate. So from 10 units of wealth to 100 units, he feels a fair increase in happiness. But from 100 to 200, the increase is not as much as he felt when it went from 10 to 100. So increasing wealth is giving him happiness, but not as much as the first units of wealth gave. So to this investor, it will be relatively tougher to lure him with big wealth. A risk-seeking investor sees a convex utility curve or a concave indifference curve, as we'll see. So the utility curve is convex. That is, increasing wealth gives him even more satisfaction. So whatever the first 100 units of wealth gave him, or the first 90 units gave him, the next 90 units from 100 to 190 give him a lot more satisfaction. This is how much the first 90 units gave him, the increase in happiness or the increase in utility. The next 90 units give him a lot more satisfaction. This is an convex utility curve. This represents a risk-seeking investor. This person will be actively looking out risky opportunities. Even if there is a 10% chance of making $100 and there's a 90% chance of making nothing, he may still want to invest because he is greatly lured by this chance of making $100. So these are called utility functions, guys. Remember, straight line or linear for risk neutral, concave for risk averse, and convex for risk seeking investors. We now move on to how behavioral finance challenges traditional finance and the rational economic man theory. So behavioral finance says that, first of all, as we discussed, individuals may not always be risk averse. Second, they definitely do not have perfect information because they are human beings that have knowledge constraints, that have capacity constraints. They don't necessarily adhere to Bayes' formula because they don't have infinite processing power that all news they will be instantly processing and updating their probabilities. So individuals sometimes may act rationally, or they even try to act rationally, like the rational economic man theory that traditional finance prescribes, but may not always behave like this. So many times their behavior is better explained by psychology and the neuroeconomics that we talked about earlier. Basic challenges to REM or the rational economic man theory include that decision making can be flawed by lack of information or flaws in the processing of information or the decision making process. Investors sometimes prioritize short-term spending or short-term consumption over long-term savings. So traditional finance theory based on long-term investing or understanding the risk return or your liabilities for the future may not always work. Lack of perfect knowledge is definitely an agreeable challenge. Everybody agrees that nobody has full knowledge and full information. Wealth utility functions may not always be concave as assumed by the utility theory or the traditional finance theory. Individuals can sometimes exhibit risk-seeking behavior. These are the 4 challenges to rational economic man theory. Question in the essay type may very well ask you to list 2 common challenges of the rational economic man theory. So you should be able to reproduce these. Now traditional finance follows the utility theory and creates convex indifference curves. So these indifference curves depict diminishing marginal utility of consumption. So the curriculum explains this with an example of the hours of work that a person is willing to do or is willing to trade off for the hours of leisure. All these points represent indifference. That is, the happiness or the satisfaction of the investor or the individual is the same at all these points. Now let's see the difference between point C and D. So point C is 4 hours of work and 12 labor. Point D is 2 hours of work but 16 of leisure. My apologies, not labor. Now if I see the difference between point A and point B, both have 2 hours less of work. Point A and point B have 2 hours less of work. Similarly, point C and point D also have 2 hours less of work. But here, when I'm already working 10 hours, I'm willing to give up my 2 hours of work for an additional 2 hours of leisure. But when I'm just working for 4 hours, then I'm already not doing any work. Then if I want to give up 2 hours of work, I'll not be satisfied with just 2 hours of labor. Then I better be getting 4 additional hours of labor if I am to give up 2 hours when I'm already just working 4 hours. So let's understand how the indifference curve is linked to the utility function that we studied earlier. This indifference curve, just like the utility function earlier, depicts diminishing marginal utility of wealth. In the utility function, we depicted that more wealth doesn't give him as much additional satisfaction to a risk-averse investor. Similarly, more wealth does not give him as much satisfaction as the first few units of work. So first few units of work can be thought of as first few units of wealth. They give him a lot of satisfaction. He's pricing them at 4 hours of labor. But the last 2 units of work or the last 2 units of wealth are not as valuable. He's pricing them at only 2 hours of leisure. Understood how the utility function and the indifference curve theory is consistent. So that's traditional finance. It says that utility function is concave and indifference curves are convex, representing diminishing marginal utility of wealth. The problem that behavioral finance argues is that many individuals are actually unable to quantify such rational trade-offs. And these trade-offs themselves can change. So that at bad times when jobs are scarce, this trade-off or this graph entirely may change. So traditional finance assumptions and traditional finance prescriptions based on any one theory may or may not always work. Now, behavioral finance says that risk functions need not always be concave or convex. They can be more complex also. So an investor may seem to be exhibiting risk-averse behavior at low levels of wealth and even at high levels of wealth. However, at some medium level of wealth, he seems to be risk-seeking or he wants to take on more risk. It's possible that investors have more complicated functions and not a straight up concave function as required by traditional finance. Traditional finance says this is always concave, that is, behavior is always risk averse. Finally, traditional finance says that portfolios are picked according to what maximizes utility or what maximizes satisfaction. So if these were the possible investable portfolios, or if this was the efficient frontier, then I would pick the investment that gives me the maximum satisfaction. Maximum satisfaction, remember, is on the highest indifference curve. So if I see all my indifference curves and see the intersection with the available portfolios, what is the maximum satisfaction that I can achieve? A I can achieve, C I can achieve, the maximum I can achieve is D. I want to have E also. E is more satisfaction than D, but unfortunately there is no portfolio available. So traditional finance describes the concept of decision theory. So decision theory is focused on explaining how an investor makes the decision given that he has full information and processing power. So this theory has also evolved over time. So even traditional finance has more broad-based its approaches. Up till earlier or at level 1, the analysis was basically on selecting the highest probability weighted payoff. That is, which is the portfolio that has the highest expected return. That is the portfolio that will be picked. Subsequently, we added expected utility, not expected return. So the same return can have different utility for different people. A 10% return may give me a different amount of satisfaction, may give you a different amount of satisfaction. So it is not the amount of return that matters. It is the satisfaction that are derived from that return that will determine whether the portfolio or the stock will be picked or not. Focus then went on not just return and utility, but also on the risk. So risk is incorporated by maximizing expected utility for a given amount of standard deviation or a given amount of risk. Risk by definition can be measured. So if there is a 10% probability of a 20% return, 50% probability of a minus 10% return, and 40% probability of a 30% return, then risk or standard deviation can be measured as we did in level 1 and level 2. Later evolutions to decision theory and traditional finance incorporated uncertainty as well. So uncertainty is defined as unknowable outcomes. So this by definition is immeasurable. That is, sometimes outcomes happen that I don't have any idea about. If I don't have any idea about what probability will I assign and what standard deviation will I calculate. So later evolution of decision theory incorporated uncertainty as well into the traditional utility analysis. And finally, recent theories are using subjective analysis as well, situations where probabilities cannot easily be measured. So the curriculum doesn't mention any detail or any formula or any of these theories. It just says that the traditional finance theory has also evolved and then takes us to the behavioral finance theory. So behavioral finance gives us a very interesting theory of bounded rationality. So bounded rationality says that there are limits on the knowledge intake capacity of people, and it hence removes the assumption of perfect information or fully rational decision making and consistent utility maximization. So bounded rationality says that individuals satisfice. They do want to make the best decision. They do want to make the traditional finance utility maximization decision, but they are just not able to all the times. So individuals keep looking for more options and more alternatives until they find a satisfactory option or a satisfactory alternative. So that is, they satisfice, and that satisfactory option may not necessarily be the utility maximizing option. So Thomas Giffen has cash that he wishes to earn interest on with sufficient liquidity and at least above a 5% annualized rate of interest. He has decided to deposit the funds in a savings account at the bank down the street. The bank posts the annualized rate of savings accounts as 6%. Explain how this decision has violated rational behavior but is consistent with bounded rationality. So for the first part, it is sufficient to say that he did not explore other options. Or you can say he did not explore all options, hence he cannot be utility maximizing because all options need to be considered. This is enough. For the second part, you can just write he accepts the first option where he is satisfied. Hence, it is consistent with bounded rationality that investors satisfies, but it is inconsistent with rational behavior. Now, arguably the most important aspect of editing and evaluating decisions or the decision-making process from a behavioral finance perspective is the concept of prospect theory. So prospect theory is an alternative to the traditional finance method of expected utility theory that describes how individuals actually pick investment alternatives or pick portfolios or evaluate prospects within behavioral and cognitive constraints. So prospect theory, that is a part of behavioral finance now, says that when evaluating any investment, consciously or subconsciously, all of us follow two steps. The editing phase tries to simplify the choices and the options that we have to evaluate. So whatever information that is there at our disposal, we mentally edit the information so that it becomes easier to evaluate. That editing process happens within our cognitive limitations, and we face limitations in evaluating large amounts of data and large amounts of information. In the evaluation phase, investors use this edited information to decide which investment alternative they would like to pick. Key points here is that investors now focus on loss aversion rather than risk aversion. So they don't like accepting a loss. In fact, if they are presented with the possibility of a sure loss, they often tend to be risk seeking and want to take any chance of giving up that sure loss. So investors exhibit loss aversion rather than risk aversion. Investors are more concerned with the change in the wealth rather than the absolute level of wealth per se. Investment alternatives are considered from the perspective of how much they add or they take away from that wealth. Investors place greater value on a loss than on a gain of a similar amount. That is, most of the investors would not take the gamble where there is a 50% chance of gaining $100 and 50% chance of losing $100. So the expected payoff is zero. The reason that you do not take this gamble is because you place more value on this loss, or this loss is more destructive than the increase in wealth from this gain. Investors fear losses and can become risk seeking in an attempt to avoid them. So if you're already in a loss, you tend to double your bets, or you then become even more risky in order to get back from that loss. Experiments have shown, like we discussed, that most individuals will not take a gamble that offers 50-50 odds of equal but opposite payoffs. That is, they place greater value on a loss than on a gain of an equal amount. So let's study the steps in detail. Editing has 6 operations involved. So when we are presented with large information from a behavioral perspective, before we start evaluating the different stocks, we edit the information in the following manner. First step is called codification. So codification says that outcomes are perceived as either gains and losses rather than the final stage of wealth or welfare. Now this gain may not necessarily be greater than 0, or loss may not necessarily be less than 0. So greater than 10%, greater than 15%, whatever is the investor's perception, but he will classify every outcome as either a gain or a loss. In the process of codification, all prospects, that is all investment alternatives, are coded as a gain or a loss with the corresponding probability. For example, an investment alternative to begin with will be thought of 25% chance of getting to $70, 20% chance of getting to $30, 15% chance of getting to $30, another 40% chance of getting $180. So in the different scenarios that you have analyzed, this is how you see the outcome and the associated probabilities. The probabilities all initially sum up to 1. Then I follow the process of combination. That is, the probabilities associated with identical gains or losses are combined. So in the example earlier, in 20% of the cases I saw a gain of 230, and then I realized that in another 15% of the chances also the gain was 230. So these two options can be combined, or this alternative will be evaluated as 25% chance of 270, 35% chance of 230, and 40% chance of 180. The third step is called segregation. So segregation involves separating the certain and uncertain components of a gamble. So let's say a gamble offers me 50% chance of gaining $50 and 50% chance of getting $100. So in half the times I get $50 and half the times I get $100. This will be thought as 100% chance of getting $50, because in either case $50 I'm definitely getting. So it will be thought of as 100% chance of getting $50. and 50% chance of getting nothing and 50% chance of getting $50. So instead of thinking of it as 50, 0.5, 100, 0.5, I'll think of it as 51 and 50% chance of getting nothing and 50% chance of getting $50. So I codify, then I combine, then I segregate. The third step is cancellation. This is where I start simplifying stuff for myself now, and I eliminate identical outcomes. So if I'm analyzing two prospects, that is either I want to invest in A or B, Microsoft and Infosys, I codify, combine and segregate the alternatives for A, and I similarly do the exercise for B. Before I start evaluating them, whatever is an identical outcome, I will cancel, because I don't want to spend my brain power in analyzing same things, because that is the same for A also and for B also. So to the next stage, I will only take the remaining outcomes. The next stage is called simplification. In simplification, prospect theory simply says that exact probabilities will get approximated. So 19% chance of getting $5 or 23% chance of getting $7 can be approximated as 20% chance or equal chance of getting $5 or $7. Or if you say 49% chance of getting $51 will be thought of as 50-50, because in our brains we are not so precise to the second decimal point. The last step of the editing process detects dominance. That is, some choices I will outrightly delete. So if I have two options like X and Y, where 50% of the times X gives $3 and another 50% of the times X gives $2. However, alternative Y 70% of the times gives $5 and 30% of the times gives $8. I don't even need to evaluate X further, because Y clearly dominates X. Even in the worst case, Y pays better than the best case of X. Before we move on to the evaluation stage, there is one anomaly that we should be aware of that can sometimes happen while editing, that is called isolation effect. So editing may lead to the isolation effect that says that investors sometimes consciously or subconsciously focus on just one factor, ignoring the others. So assume an individual is asked to choose between two lucky draws. Lucky draw A offers a payout of 5,000 30% of the times and 0 70% of the times. Lucky draw B offers $8,000 20% of the times and nothing 80% of the times. So which outcome are we likely to choose? So in situations like this, we normally find that investors choose option B. However, if the draw is presented slightly differently, that is, a lucky draw C offers a 100% chance of winning $5,000 and a lucky draw D offers a 70% chance of winning $8,000. And now if we ask investors which of the two options will they prefer? So in this case, we find that investors normally choose option C. Now, if expected payoff was the logic behind making the decision, then expected payoff was higher in B and the probability was lower. Here also, the expected payoff is higher and the probability is lower. But for some reason, here investors choose option C even though it has a lower expected payoff. So he says that these effects are common. How the question is framed, which choice was given first, which choice was given second, all these factors can have an influence of which option I pick. So framing and the order of lottery can produce inconsistent and irrational choices. The second phase of the prospect theory tries to evaluate the different alternatives that have already been edited and tries to pick the best alternative. The utility is calculated as the probability of the outcome multiplied by the utility of the outcome. So the absolute gain, that is $10, $20, $270, doesn't matter. What is the utility of that gain or that loss to the investor is what matters. So we keep the utility, multiply it with the probability, but even that probability has some subjective weighting. Sometimes, even though probability may be 20%, investors tend to overreact to low probabilities and underreact to high probabilities. So subconsciously they reduce high probabilities and they increase low probabilities. Even though there may be a 5% chance of a gain, in your mind you think of it as slightly higher at times. Sometimes it may not be there. So even that probability has a weighting assigned to it. That the probability that came from our editing phase can be further upped or reduced. So for all outcomes, you will do this calculation and sum up to calculate the utility of each alternative. The total utility of all alternatives will be compared and you will pick the option that gives you the highest utility. P1 and P2 are the probability weights of the outcomes x1 and x2 that came from editing. V is the function that assigns a utility to an outcome, and W is a probability weighting function, that is, even these traditional probabilities can be increased or decreased subjectively by the investors. So implications are that W reflects a tendency of individuals to overreact to small probabilities and underreact to large probabilities. Value function is based on changes and not the absolute levels of the wealth, and the value function tends to be S-shaped and asymmetric, representing that individuals experience a greater decline in value for a given loss than a rise in value for a corresponding gain, as we discussed earlier. So the value function looks something like this, or the utility function that assigns a utility to an outcome looks something like this. A similar amount of loss will take away a lot more value. A similar amount of gain will give us relatively lesser value. Now the curriculum explicitly mentions that there is no quantitative analysis needed. However, for the purpose of better understanding, we will do a small example to understand how the evaluation phase actually happens. So there's a 20% chance of a minus 5% return. However, please note that this outcome does not matter. What matters is the utility from the outcome. So there's a 20% chance of a minus 100 utility. There's a 20% chance of a minus 20 utility, a 25% chance of 40 utility, and a 35% chance of plus 110 utility. However, the investor thinks that the first two outcomes are slightly more likely and the second two outcomes are relatively less likely. So he applies a subjective probability, or he multiplies this calculated probability by 1.3 and this by 1.2 and this by 0.88 and this by 0.8 before he does his evaluation. This is the W that we had studied in the probability function. So given the probabilities and the utility, let's calculate the expected utility of this investment. So 0.2 into 1.3 into minus 100 plus 1.2 into 0.2 into minus 20 plus 0.88 into 0.25 into 40 plus 0.8 into 0.35 into 110. So the expected utility for this alternative comes out to be 8.8. Whether or not the investor will make the investment depends on all other alternatives. So he'll similarly evaluate all other alternatives and pick the alternatives that have the highest utility. So to summarize traditional finance with behavioral finance, we find that traditional finance assumes unlimited perfect knowledge, whereas behavioral finance assumes capacity limitations on knowledge. Traditional finance assumes utility maximization, whereas behavioral finance assumes that investors satisfies. There's fully rational decision making, and here there are cognitive limits on the decision making that you do, as evidenced in the prospect theory in the editing and evaluation. Traditional finance assumes definite risk aversion, Behavioral finance says that risk aversion, risk seeking behavior, or risk neutrality depend on the reference. So at times you can be risk seeking, at times you can be risk averse. We'll now move on to understanding what traditional and behavioral finance have to say about capital markets and portfolio construction. The traditional finance perspective is that markets are efficient. Just to revise, weak form efficiency says that current prices incorporate all past price and volume data. That is, managers cannot consistently generate excess returns using technical analysis alone. That is, just by analyzing charts and trying to capture trends, you will not be able to make any excess return. Generally, the weak form is well supported, and we have found that there is no long-term trend or there is no sustainable trend that is seen in any stock price data, and stock price changes do appear to be random. The semi-strong form of market efficiency says that current prices reflect all public information, including past price and volume data. So it does incorporate the weak form as well, and it says that new information is instantly and accurately reflected in the stock prices, as we studied in the Bayes theorem and other methods through which investors analyze and update the information. So managers cannot generate excess returns using technical or fundamental analysis. Both are useless. Even the semi-strong form of market efficiency is generally well supported. Majority of the fund managers and professional money managers have negative alpha. That is, there are no free lunches, or by analyzing public information, you cannot generate excess return. The strong form efficiency says that prices reflect all privileged information as well, that is insider information as well, including the semi-strong and the weak form assumptions. So this theory says that no analysis based on inside or public information can generate excess returns. The strong form of market efficiency is generally not supported and generally not accepted, as we have seen that trades involving non-public information are associated with excess returns. So there are various anomalies that seem to be existing in the markets that make us challenge the efficient market theory. So fundamental anomalies relate to stock returns and stock fundamentals. So these are violations of the semi-strong form of market efficiency, that is, analyzing fundamentals can actually generate excess returns as evidenced by fundamental anomalies. Please note that the strong form incorporates the semi-strong form. So if you are violating the semi-strong form, you are automatically violating the strong form of market efficiency. Value stocks, we've seen that are stocks with lower price to earnings ratio, lower price to book ratio, lower price to sales ratios have outperformed growth stocks. Similarly, small cap stocks have outperformed large cap stocks. This suggests that if we analyze the PE ratios or the market caps, then we can use that analysis to generate some excess return. However, other theories suggest that these abnormal returns are not excess return. They are just a representation of the higher risk that smaller stocks have or value stocks have. Technical anomalies relate to the studies of past stock price and volume data. So technical anomalies would automatically be a violation of all three forms of efficiencies. So semi-strong form includes the weak form. The strong form includes both the semi-strong and the weak form. So studies have shown that if the short-term moving average goes above or below the long-term moving average, so as a stock price goes above its 200-day moving average or a 150-day moving average, it normally signals a buy. Or if it moves below its 200-day moving average, it normally signals a sell. And other such studies also show that signals or analysis like this do provide some value. Similarly, we've seen some calendar anomalies globally. That is, stocks have abnormally high returns in January and on the last day of each month and in the first 4 days of each month. So if this exists and this persists for a long time, then this definitely is a violation of the weak form of market efficiency, because analyzing trends does seem to give us some profit making opportunities. Transaction costs, however, we have found out remove most of these benefits. So while the stock prices may have been slightly higher or there would have been positive returns, if we account for the brokerages, leverage and additional costs needed, then really trading just on these anomalies would not give us any excess profit. So the conclusion just is that generally the efficient market hypothesis holds. However, anomalies do exist, and behavioral finance tries to argue that these anomalies may be a result of behavioral biases and the markets may not be efficient. The traditional finance assumptions are definitely not all true, as we have argued at various points. However, behavioral finance does not give us any alternative theory like the utility theory. So there is still no behavioral theory. However, 4 alternative models have been proposed that try to explain behavior in the real world. The first model is the consumption and savings model. Second is called the behavioral asset pricing, the behavioral portfolio theory, and the adaptive markets hypothesis that we'll just go through. So the consumption and savings model says that individuals do not necessarily achieve the optimal balance of short-term consumption and long-term investing. That is, we have a tendency to overspend in the short term and save less for the future than what would be predicted by traditional finance. So why does this happen? Is because of a lot of reasons. Framing can affect our decisions. The way a question is asked or the way an information is presented can affect the way individuals perceive the information or take the decision. So that makes us overspend at times or spend less at times. There is a self-control bias, that is, there is greater emphasis on current consumption than on future goals, so we are not always able to control our desires. Mental accounting is an important concept that says that different portions of the wealth are assigned to meet different goals. So we segregate our return expectations not on a consolidated basis, or we figure our return expectations not as one consolidated expected return. Rather, we have different goals and a different expected return to meet each goal. So we create different portfolios. Each of them is designed to meet a specific goal, and the correlations amongst the portfolios are often ignored. So portfolio construction doesn't happen in the traditional finance way that says that all wealth should be looked at as one and correlations must be considered to find the optimal risk-return trade-off. The consumption and savings model further says that how we mentally classify our wealth also impacts whether that wealth will be saved or it will be consumed. So if we think of our wealth as current income, then it is most likely to be spent. If we think of it as a current asset or a current saving that has happened, then it is less likely to be spent. And if you think of it as future income that has come a little early, then it is least likely to be spent. So let's assume that I receive $100 inheritance from some far aunt of mine who expired and who left me $100. Now whether this $100 will be spent or whether it will be saved depends on how I look at this wealth. If I think of it as current income, that it's just additional salary for the month, then I'm likely to spend it. If I think of it like my savings bank account money, so normally for spending I don't like to draw on my previous savings. My current income I can spend, but I would not watch a rock concert by drawing or by breaking a fixed deposit. So if it is a current saving, or if I think of it as a saving that has come, then I will likely not spend it. If I think that this was my future income, or this was already in my calculations, I was expecting this $100 10 years later. However, my aunt died early, so the money came 10 years earlier. So this was anyways my future income that has come early. So if it is a part of your future income, then you're definitely not going to spend it now, because you have planned as though it will come in the future and then you will use it. So just to explain further, if you had to make $1,000 expense on purchasing something, the first means of making that expenditure would be to use your current income. If your current income is not enough, then you may want to draw on your current assets, that is break your fixed deposit or break your savings account and use your savings to fund this purchase. Only in the last case or as a last resort would you want to draw on your future income. That is, sell your ancestral house or sell your parents' house to fund this expense. So whatever wealth is classified as future income or that you're expecting will come to you in the future is least likely to be spent today. The second model is called the behavioral asset pricing model. So capital asset pricing model assumes that market prices are determined through an unbiased analysis of risk and return. In fact, the stock returns are dependent only on the market risk premium is what we studied in capital. Behavioral asset pricing model adds a sentiment premium to the capital. And the model says that sentiment premium is higher for stocks where there is a great dispersion amongst the analysts' forecasts. So for volatile stocks or commodity companies or real estate companies, one analyst may have very high earnings, another analyst may have very low earnings. The dispersion amongst the analyst forecasts will be very high, indicating unpredictability or indicating high volatility of this asset. For companies like FMCG, pharmaceutical companies, where we see that most of the analysts have their estimates in a narrow range, that is, predictability is relatively higher, the sentiment premium required from these stocks is less. So that's the behavioral asset pricing model that tries to explain portfolio construction and expected return calculation. The behavioral portfolio theory says that people don't hold well-diversified portfolios as traditional finance says. People hold either near riskless securities or considerably riskier assets. So they are either very low risk assets or very high risk assets in my portfolios. There are less medium risk assets because of the mental accounting that we described earlier and because of the way that we structure our portfolios in layers according to the goals. So I have a goal of purchasing a house, of funding my children's education, and of going on a vacation. Now these two goals are fairly important. And this third goal of doing a world tour when I'm 60 is not a very important goal. Even if I miss out on it, nothing in my lifestyle changes. So what investors tend to do is that these two goals are funded by very low risk securities. So I want to be sure that I want this money or I have this money by the time my son goes for education or by the time I need a house. For these vacation type of goals, I invest in very high risk securities. And most of our goals tend to be like this. Either they are very important or not important at all. Because of this, my portfolio, that is a segregation of different layers, consists of either very low risk securities or very high risk securities. Now, whether I allocate a layer to low risk securities or to high risk securities depends on the importance of the goal. So sometimes high returns are important, like in the case of the vacation house. Sometimes low risk is important, like in the case of education funding for the children. So if the required return is high, automatically I will need to take more risk. If the investor has a more concave utility function, please recall concave means risk averse, then he will tend to diversify his portfolios more. He would not want to concentrate his positions into one or two assets. If he has a convex utility function, that means he's more risk seeking, then he wants the best investment. He doesn't want to reduce his returns by adding other investments that are not giving as high a return. He wants the one or two best investments, and the portfolios tend to be more concentrated. We are trying to analyze how this layer is constructed and what all assets will actually go into this layer that is designed to meet a particular goal. if the individual feels there is a perceived information advantage, that is, I know something about this stock that nobody else knows, then the layer can be concentrated in these one or two securities that you think you have additional knowledge of. Investors in behavioral finance exhibit loss aversion. That is, either they will not invest at all. For a fear of loss, they tend to hold too much cash and don't invest at all. Or they continue to hold risky out of money positions for elongated periods in the hope that they will come back in the money because they don't want to recognize a loss. So this also affects what kind of securities will be there in my layer. So if there are loss making securities, then they'll probably continue to remain because I don't like booking a loss. So the portfolio will be suboptimal from a traditional finance perspective, as each of these individual layers are constructed without any regard to the correlation between them, or your wealth has been segregated into different layers. Actually, the correlations amongst all these classes should be considered to analyze the risk return profile and the optimality of any portfolio. This theory, however, can explain many social behaviors. So we see people buy a lot of insurance and simultaneously buy a lot of lottery tickets as well. So they are risk averse on one side and they are risk seeking on the other, not holding sufficient moderate risk assets. So our portfolios either have government bonds or they have real estate stocks or have very risky stocks. So a lot of portfolios we see have very low risk securities and very high risk securities. The adaptive markets hypothesis says that successful market participants apply heuristics. So remember, heuristics are rules of thumb that investors derive from their experience. So as we become more and more experienced, we realize that real estate stocks are bad, or we realize that companies that give good dividends give good returns, or we realize that IT stocks are good stocks to hold. So these are all heuristics that investors derive from their own experience and from their own analysis and assessment of their investing. Investors use these heuristics into actual decision making and actual portfolio construction until the heuristics no longer work. So one heuristic, please understand, may work at some point in time or at some market, but it will not work always. So there will be phases when real estate stocks don't do well, and there will be phases when real estate stocks do well. So these heuristics keep changing, and investors have to adapt and figure out new rules of thumb or new rules of investing depending on the current market situation. Those investors who cannot adapt do not survive. So the adaptive markets hypothesis is consistent with the theory of satisficing rather than maximizing utility. So they look for heuristics until they find a heuristic that satisfactorily gives them returns, and then they start applying that heuristic. That heuristic may not always be true, it may not always be the optimal solution, but that is how investors invest. The adaptive markets hypothesis leads to 5 conclusions. First, that the relationship of risk and return is not stable. That is, the market risk premium keeps changing over time as the competitive environment changes. That is, as more and more people start following the same heuristic or start investing in the same manner, stock prices tend to go up, or the market risk premium reduces, or the discount rate starts reducing as is visible in the higher stock prices. Active management can find opportunities to exploit arbitrage and add value. So if people are using the wrong heuristic and you've discovered some new heuristic that you think people will follow soon, then you can make an excess return. No strategy will work all the time. Adaptation and innovation are essential for the continued success of any fund manager, and survivors are those who change and adapt. So that's the final theory that behavioral finance gives on capital markets and portfolio construction. So that was the first reading on the review on behavioral finance that gave us the behavioral finance perspective. We compared traditional finance with behavioral finance, highlighted the differences, and had a very good introduction and beginning to behavioral finance. In the coming reviews, we'll study about the different biases that can come in because of psychological factors and how that affect portfolio construction and decision making. So practice a lot of questions. Both item set type questions as well as essay type questions are expected from this review. So make sure you use your question bank and all sources. Do all questions behind the CFA curriculum books and practice as much as you can. So thanks a lot and see you next time.